someone who defaults when you dance the mortgage waltz. I'll show you what you need to learn so you won't get lender heartburn. You'll learn not to do somersaults when you dance the mortgage waltz. Hello, this is J. Mike Perkins, and welcome to Music and Mortgage. And if you're a first-time home buyer and it's your first time to dance the mortgage waltz, you will find this information invaluable as I cover mortgage basics. So let's start at the beginning. What does the word mortgage mean? Well, it comes from a 14th century French word, mortgage, which was made up of two other words, mort, as in mortality, and gage being a type of pledge that you would make that was guaranteed by some asset that you would put up. So the literal translation is death pledge. And given the fact that a mortgage is the most money that you're likely to ever borrow in your lifetime, and given the fact that the payment plan could be 30 years, it may seem like a death pledge, but it's translated in the modern world as a type of loan, typically long-term, that's used to purchase or refinance a piece of real estate where the property itself is pledged to guarantee payment of the mortgage. A mortgage is an example of what's called a secured loan. Loans come in two types, unsecured and secured. An unsecured loan would be something like a department store credit card. If you went and bought a pair of shoes and you didn't pay for the shoes, they can't come and repossess them. A mortgage is a type of secured loan, like a car loan. If you don't pay for it, they can come and take the collateral. Now, when you go to close on a home, you're going to sign a ton of paperwork. But within all that stuff, in my opinion, there are three documents that are by far the most important. The first one is the deed. That's the document that shows that you actually have ownership of the property. The second one is the note, assuming that you have a mortgage. And the note's going to go over the terms of the money that you borrowed. And the third one is called the deed of trust. Now, the deed of trust is an agreement that you have with the lender that says that if you default on the note, they have the right to go in and take possession of the property, sell it, and use the sales proceeds toward the loan balance. The claim that a lender is going to have on your home until you pay the mortgage is called a lien. If the lender takes possession of the property and sells it, it's called a foreclosure. It's possible to have more than one lien at the same time. In other words, you can have two mortgages. You might have a primary mortgage, the one you use to buy the property, which would be the first lien. And then keeping this in place, you may later turn around and get something like a home improvement loan or a home equity line of credit. That would be known as a second mortgage or a second lien. Let's go over some common mortgage types. By far the most popular loan out there, the one that has 70% of the market, is called conventional, also known as conforming conventional. It requires a 5% down payment, but 3% down payment programs are possible if you qualify. Conventional is going to have the lowest interest rate, but your credit has to be good to qualify for conventional, and they may be somewhat restrictive on your debt payments relative to your income. The next most popular program out there is called FHA, which stands for Federal Housing Administration. It requires a 3.5% down payment. It has a low interest rate. It may not be as low as conventional, but it will be close. And it's easier on your credit and it's easier on your debts relative to your income. The problem with FHA is it has a lower loan limit than conventional, and that could be an issue depending on the price of the home. The third most popular program out there is VA, a Veterans Administration mortgage. Now, you have to be eligible for it according to the VA, and the lender has no control over that. But if you are, it's a good program. It's 0% down. It has a low interest rate, which is similar to FHA, and it's easier on your credit compared to conventional. The fourth most popular program out there is called Jumbo. Jumbo, of course, meaning large. And these are loan amounts that are higher than the conforming conventional limits. Around 5 to 10% of all mortgages fall into this category. Jumbo has the highest standards to qualify for. You have to have an excellent credit score, and it usually requires a larger than normal down payment. The fifth most popular program out there is called USDA, which stands for U.S. Department of Agriculture. Now, the property must be in a USDA designated zone, and once again, the lender has no control over that. But if it is, it's a good program. It's a 0% down, and your credit has to be a little better than FHA, but it doesn't have to be quite as good as what conventional would require. Now, there are a lot of other miscellaneous loan programs out there, and it's hard to cover all of them. There are programs based on your bank deposits. There are some that are based on your assets. There are profit and loss statement programs for self-employed people. Real estate investors have a program where they can qualify based on the rent that they take in. There are loans for non-permanent resident aliens, and then there are hard asset money loans where they basically don't care about your income. They're looking at the value of the property and using that to make the decision. And I can guarantee you, as time goes on, there will be more new loan programs. As you may know, mortgages come in fixed rate versions and adjustable rate versions. Fixed rate versions are the most popular, with about 79% of the market. The most common terms are the 30-year fixed and the 15-year fixed, but other terms are possible. One thing to note, the interest rate on the 15-year is about 0.5% lower than the 30 typically. Adjustable rate mortgages can be complicated, but most of them work something like this. You start off with an introductory teaser rate, which is typically lower than the current 30-year fixed rate. That will be locked for some period of time, typically 3 years or 5 years, but other periods are possible. Then it will start to adjust. The adjustment period is typically once every 6 months or once a year. Most of these programs will have limits on how much the interest rate can adjust each period and how much it can adjust over the life of the loan. If you don't understand how these programs work, you should not get one. But if you do understand how they work, they can be a valid option. Let's look at a payment example of a 30-year mortgage versus a 15-year mortgage. Let's assume that the loan amount is $300,000, and let's assume the interest rate on the 30-year mortgage is 6%, and the interest rate on the 15-year mortgage is 0.5% lower at 5.5%. The payment, principal and interest, not including taxes and insurance, on the 30 would be $1,799, and on the 15 it would be $2,451. Notice that the 15-year payment is only about 27% higher than the 30-year payment. Now here are two important things you need to know. The first one is you can pay a 30-year mortgage in 15 years by increasing the payment. In this example, if you increased your payment by $733 a month to $2,532, you would pay the loan off in 15 years. And second, you need to always remember that the average life of a mortgage loan is only about 7 to 10 years. So if you're an average person and you go and get a 30-year mortgage, you won't have that same mortgage for 30 years because in that time period, 7 to 10 years, odds are you would have either refinanced that loan or you would have sold the house and gotten a new one. You know, when you start dancing the mortgage waltz, one thing that's going to come up over and over again is this word here, points. Well, what in the world are points and should you pay them? It just depends. A point is a charge which will permanently lower your interest rate. A full point is equal to 1% of the loan amount. However, they're often priced in partial points. The easiest way to explain this issue to you is to give you an example where in one case I would pay points and an example, in my opinion, where I would not pay points if it were me. I've been a loan officer for a long time, and it's not unusual to walk into the office and get a rate sheet that looks something like this. 6% is 0 points. That's what's known as the par rate. Now, to get down to 5.875, it's cheap. The lender's only charging 1/4 of a point, and if we have a $300,000 loan, that's $750. However, to get to the next rate, 5.75, boy, that's priced expensive. The lender wants 1.125 points to get there. That costs $3,375. Now, the answer on what you should do depends on how long it takes you to get your money back. In this example, with the 1/4 of a point, it only costs $750. You save $24 a month, and it only takes you 31 months or 2.6 years to get your money back. In my opinion, that is worth doing. However, the 5.75, boy, it takes you 70 months or about 5.8 years to get your money back. And in my opinion, it is not worth doing. Thank you very much for watching. This is J. Mike Perkins. If you're on YouTube, please help my channel by hitting like and subscribe. And now, more music. If you need a mortgage in Texas, then you should give me a try. All you've got to do is scan the QR code and apply. Thank you very much.